In the fast-paced, sometimes pretty wild world of crypto, everyone's looking for ways to make their digital assets really work for them. But how do you navigate that? When one path promises potentially like jaw-dropping returns, while another one is all about stability.
Yeah, it's a classic dilemma, isn't it? Like choosing between maybe a high-growth tech stock with all the volatility or a solid dividend payer.
Exactly. So today we're diving into this fascinating choice that comes up constantly in decentralized finance: yield farming versus staking. Our mission here is really to arm you with the essential knowledge, the core differences, so you can start thinking about which approach might align best with your own goals.
And we've really gone deep on the sources for this one. We've got comparative guides, expert analyses, all sorts of things. The goal is to pull out those key nuggets, so you understand not just the headline risks and rewards, but really grasp which strategy fits you. What's really interesting is how clearly the trade-offs are laid out in the material. It's almost like a direct challenge to the investor.
Yeah, as I was digging through our research, that stark contrast really jumped out. High returns, low stability on one side. You see these things promising, like triple-digit APYs sometimes, but then the research just flashes these big neon warning signs, right? Complexity, risk. And then the other option, staking, seems almost, humble. Lower returns, but it whispers about predictability, ease of use. What's the immediate kind of feeling our sources want listeners to get when they see that choice?
Well, the sources pretty much immediately frame it as not really a better or worse thing. It's more about your temperament, your risk tolerance. They definitely set up staking as the more foundational, maybe less volatile option.
Okay.
You're typically looking at APYs, annual percentage yields, somewhere in the, say, 3 to 15% range, usually.
Right, so not headline-grabbing numbers.
No, definitely not the kind of returns that make, crypto Twitter explode. But the idea is consistency.
Okay, let's unpack staking a bit more then. For someone maybe newer to this, what are they actually doing when they stake their crypto? And what are the real risks there beyond just, the price of the token going down?
Right. So staking is essentially you locking up your crypto assets. You're doing it to help support the operations of a specific blockchain network.
Okay, like securing the network.
Exactly. Think of it almost like putting money in a, maybe not high yield these days, but a savings account. But instead of a bank, you're helping secure that decentralized ledger. And for doing that, the network rewards you, usually with more of that same crypto.
How does that actually work, the securing part?
It relies on what are called validators. These are basically powerful computers or entities running the software. They propose and verify new blocks of transactions, making sure everything's legit. So by staking, you're either running a validator yourself, which is pretty technical, or more commonly, you delegate your tokens, your support, to an existing validator. Either way, you're strengthening the network security.
Got it. And the risks, besides price?
Yeah, so token price drops are always a risk in crypto, obviously. But the sources also really highlight something called slashing.
Slashing? Sounds painful.
It can be. It's a crucial detail. If a validator you've delegated to misbehaves, maybe they go offline for too long, or worse, they try to cheat the system, the network can penalize them. And that penalty often involves destroying or slashing a portion of the staked tokens, including yours.
Oh, wow. Okay, so you're trusting the validator's performance.
Exactly. It's a mechanism to keep validators honest, but it's a definite risk for stakers if they choose poorly or just get unlucky.
Now, one thing that kept coming up in the research on staking was this idea of locked liquidity. It sounds like a drawback, right? Your funds are tied up. But do the sources talk about why networks need that, and maybe how it could even be, an advantage sometimes?
Yeah, they absolutely do. That lockup period, and it can range hugely, days, weeks, months, sometimes even years, depending on the network. It's pretty fundamental to how proof-of-stake blockchains work. It ensures validators, and by extension their delegators, have actual skin in the game. They can't just pull out instantly if things get choppy. It provides stability.
Okay, that makes sense for the network, but for the staker?
Well, for you, the staker, it can kind of enforce a longer-term view. It discourages maybe impulsive panic selling during market dips. And, by contributing to the network's stability, you're indirectly supporting the potential long-term value of the asset you're staking.
Yeah.
So it's this commitment that really underpins that more stable, predictable nature we talked about.
Right. Okay. So staking is the steady-ish hum, predictable, committed. But what about the other side, the crypto equivalent of like a rocket launch, yield farming? Our sources spent a lot of time on this, and it really does sound like the Wild West of DeFi sometimes. How do those sky-high returns actually happen? And what's the real catch? Because there's always a catch, right?
Yes, there's definitely a catch, or rather several catches. So yield farming is where things get significantly more complex, way more complex than staking. And yes, the potential returns can be, well, astronomical sometimes. You hear numbers like 10%, 50%, over 100% APY, sometimes way higher, especially for really new or frankly risky projects.
How? What are you doing to get that?
Essentially, you're providing liquidity. You're lending your crypto assets, often in pairs, to things like decentralized exchanges or lending protocols, other DeFi platforms. You put your tokens into what's called a liquidity pool, and that allows other people to trade against that pool or borrow from it.
Okay.
And for providing that service, that liquidity, you earn rewards. Usually it's a share of the trading fees generated by the pool, and often you also get additional governance tokens from the project itself as an extra incentive.
Right. Those extra token rewards can really juice the APY.
They absolutely can. But it's so easy to just focus on those flashy APY numbers.
Yeah.
Our sources really hammer home a less obvious risk, impermanent loss.
Impermanent loss. Okay, I've heard this term. It sounds weird. Not permanent.
Yeah, the name is a bit misleading. It can definitely be permanent. It's not just a fancy term. Imagine you put, say, $500 worth of token A and $500 worth of token B into a liquidity pool.
Okay, equal value.
Right. Now, if token A suddenly skyrockets in price compared to token B, the pool's automated mechanism, the automated market maker, rebalances. It sells some of the appreciating token A to buy more token B to keep the value ratio constant. So when you eventually withdraw your funds, you might find you have much less of the high-performing token A and much more of the underperforming token B than if you had just held both tokens separately in your wallet.
So even if both tokens went up, but one went up way more, you could actually end up with less total value than just holding.
Precisely. That's impermanent loss. It's this divergence loss. It catches so many new yield farmers by surprise, even when the overall market seems to be doing well. It's a silent killer, as one source put it.
Wow, okay. That's a really crucial point. The market moving up could still mean you lose out relative to holding. What about other, maybe more straightforward risks? The sources mentioned smart contract vulnerabilities pretty heavily.
They did, and yeah, for very good reason. Our research pointed to, countless cases where huge amounts of money, millions, were lost. And not because the market crashed, but because of a bug, like a single line of exploitable code in the smart contract that runs the DeFi protocol.
So the code itself fails or gets hacked.
Exactly. Or sometimes, it's even more malicious, there have been cases of rug pulls.
Rug pulls.
Yeah, where the project developers who might have special control over the contracts initially just pull out all the valuable liquidity from the pool, leaving everyone else holding worthless tokens.
Oh man, that's rough.
It's brutal. It really highlights why those super high returns often come attached to protocols that are maybe unaudited or very new, or just plain risky. It's truly a trust but verify situation, and even then. Plus, you still have the general token volatility risk, just like staking. But it can be amplified in yield farming, especially if you're providing liquidity for less established, more volatile, or even illiquid tokens. Your principal can evaporate fast.
Okay, so if staking is often described as sort of set it and forget it, relatively speaking, yield farming sounds like it needs constant attention, like a full-time job.
That's a very good way to put it.
But wait, the sources also mentioned flexible liquidity with yield farming. You can usually withdraw at any time, right? Unlike staking's lockups. How does that square with needing active management? Seems contradictory.
That's a great observation, and it highlights a key difference in the type of management needed. Yes, technically, you can often withdraw your funds from a yield farming pool whenever you want. There usually isn't a fixed lockup period like staking.
So it's liquid.
The assets can be moved, yes, but the returns are so volatile, and the risks, like impermanent loss, are constantly changing based on market prices. So while the liquidity is flexible, the predictability is extremely low. You should be actively monitoring things, daily, sometimes hourly, for really degen plays.
Why? What are you looking for?
You're checking. Has the APY suddenly dropped because lots of new capital flooded in? Has the price of one of the tokens in your pair started to tank, increasing your impermanent loss risk? Is there a brand new, maybe even higher paying farm you should move your capital to? Are there signs the protocol might be unsafe?
Okay, so the flexibility is there, but you need to constantly decide whether to stay in or get out or move somewhere else.
Exactly. It's less about being locked in and more about needing to be constantly hands-on to chase the best returns, or, just as importantly, to cut your losses quickly. Active management.
Right. So bringing it all together then, if we just look at them side by side, it really boils down to a few key factors, doesn't it? Returns, risk, complexity, liquidity, and predictability.
That's the core of it, yeah. Connecting it to the bigger picture from our sources.
Yeah.
Yield farming typically offers the potential for much higher returns than staking. Significantly higher sometimes.
Why?
But it comes with significantly higher risk and permanent loss, smart contract bugs, rug pulls. It demands active management, more technical understanding, and just constant vigilance.
Whereas staking?
Staking offers more predictable, generally more consistent returns. The risks are typically lower, mostly network performance, slashing, and token price. It's much simpler, more passive. Set it and, well, check on it occasionally.
But the trade-off there is often that locked liquidity.
That's usually the main trade-off, yes. Your capital's committed for a period.
So to summarize that core choice for you, the listener,
If you're chasing those potentially aggressive gains, if you're comfortable with and maybe even enjoy the constant monitoring, the higher technical complexity, and crucially, if you can stomach the very real risks of losing money through things like impermanent loss or exploits, then yield farming could potentially pay more. No guarantees, of course.
and the alternative.
If you prioritize stability, if you prefer more predictable, even if lower returns, and you want a simpler, more hands-off approach, then staking is generally the safer, more straightforward way to grow your digital assets over time.
So what does this all mean for you listening? Sounds like the research is clear. There's no single right answer.
Not at all.
Your choice really has to depend on your personal situation, right? Your risk tolerance, how much time and energy you actually want to spend managing crypto, your technical skills, and maybe just your overall investment horizon, long-term versus short-term.
Absolutely. It's a deeply personal decision based on those factors.
Well, we've definitely unpacked the key differences between yield farming and staking today. We've seen how one offers that allure of higher but much more volatile returns coupled with greater risk and complexity, while the other provides more predictable, stable returns, generally lower risk, but often requires that commitment of locking up your funds. The sources really drive home that correlation. Reward is often tied directly to risk and complexity.
Yeah, and this comparison isn't just about crypto, is it? It touches on a really fundamental question that applies to almost any kind of investment or even life decisions. How much active effort are you willing to put in? How much uncertainty and risk are you comfortable taking on board for the possibility of a higher reward? Versus preferring a more hands-off, predictable path, even if the potential upside is lower. It's about finding that balance that aligns with your own philosophy, your own comfort level. Something to consider not just for your crypto strategy, but maybe more broadly too.